Welcome back to the Japan FinTech Observer. Get ready for a quick hit of the latest news in Japanese finance and fintech. We're diving into the headlines, breaking down the trends, and leaving you with the insights you need to stay ahead of the curve. Let's go.
MUFG has published its monthly outlook for the Japanese yen, alongside all other major currencies. Before we get there, though, let us look at how the market fared in June. The yen weakened versus the US dollar in terms of London closing rates from 144.10 to 144.30. In addition, the yen weakened versus the euro from 163.57 to 169.49. The Bank of Japan at its meeting in June maintained the key policy rate at 0.5%, following the 25 basis point hike in January, the first 25 basis point rate hike since before the global financial crisis in 2007. The Bank of Japan is also continuing with the policy of cutting its monthly purchases of Japanese government bonds at a pace of 400 billion in Japanese yen per quarter, but announced in June that the pace of reduction will be reduced to 200 billion in Japanese yen per quarter, effective from the second quarter of 2026. Let us turn to the outlook for the Japanese yen then. As stated, the yen weakened marginally versus the US dollar in June, and apart from the dollar, was the worst performing G10 currency in June. The yen suffered more than most earlier in June, as the Middle East geopolitical risks fueled a surge in crude oil prices that hit the yen given Japan's dependency on imported energy. MUFG would assume that if the Middle East remains more stable, then this risk premium will shrink, helping the yen to catch up and potentially outperform. Besides the geopolitical risk, the outlook for crude oil is quite bearish, as was underlined by the IEA monthly report in June. As mentioned last month, FDI outflows may have also played a role in yen underperformance. The purchase of US steel by Nippon Steel could have been a supportive factor for the US dollar versus Japanese yen exchange rate in June, although there is no way of knowing when and how exactly that flow may go through the FX market. If it has gone through, it adds to the scope for the yen to play catch-up and outperform going forward. The yen may have been negatively hit by the actions to limit upside risks to Japanese government bond yields. The Bank of Japan announced at its meeting in June that the pace of quantitative tightening per quarter would be cut from 400 billion Japanese yen per month to 200 billion Japanese yen. This had been flagged ahead of the announcement as a possibility. The Ministry of Finance also cut the issuance of super long JGBs that should help reduce upside yield risks. However, MUFG sees rates at the front end of the curve as being more important, and issuance at the front end will increase in the updated Ministry of Finance plans, while the Bank of Japan is likely to turn more hawkish and potentially could be in a position to hike rates again by September. The US tariff plans will be important, but there is a good chance that Japan will reach a deal with the US to avoid the reciprocal tariff and possibly to reduce the auto tariff to the baseline 10%, subject to a quota. Inflation remains high, and food inflation in particular could influence inflation expectations. Shunto wage negotiations mean another year of strong wage growth, and the continued weakness of the yen will likely encourage a more hawkish approach by the Bank of Japan. The US will likely be expecting such an approach, given their complaints over the Bank of Japan policy impact on the yen. Divergence in monetary policy should become more apparent in the second half of the year, with the Fed restarting its easing cycle and still high inflation in Japan prompting Bank of Japan monetary tightening. Reciprocal tariffs hitting Japan would curtail Bank of Japan action, but not Fed action, and hence MUFG still sees scope for yen gains from still very undervalued levels. Turning to interest rates, the 10-year Japanese government bond yield declined in June by 7 basis points to close at 1.43%. The drop followed a sharp rise in May, when there were signs of increased investor concerns over debt sustainability and supply-demand imbalances. This was addressed through the Bank of Japan quantitative tightening pace being cut by 50% to 200 billion Japanese yen worth of Japanese government bond purchases per month per quarter. The Ministry of Finance also shifted issuance to shorter maturities to help the long end. Risks will remain, and renewed US Treasury bond instability would have knock-on effects on Japanese government bonds as well. MUFG also has seen foreign investors return to the Japanese government bond market in June, with weekly data showing foreign investor buying in 3 of the last 4 weeks, so sentiment has improved. There is only currently 5 basis points of tightening priced for the September meeting, and given the inflation data in June surprised to the upside, MUFG believes the markets are underestimating the risks. A credible strategy for helping stabilize longer-term yields would be modest monetary tightening to enhance inflation credibility and help to strengthen the yen. MUFG continues to expect a moderate increase in 10-year Japanese government bond yields over the forecast period.